Hello guys, welcome back. This is a video request, it is a topic request about mistakes to avoid that I have personally made some of those, not every one of those, and others I have kind of learned from experience to avoid. And this was asked by one of our viewers and subscribers of the channel, and I thought it would be make for an interesting topic here, so I compiled a full-blown PowerPoint here. And I'm gonna be talking about what I think are pretty much sort of like grave mistakes, or at least pretty big mistakes that you would want to avoid when investing. So this is gonna be a list of 10. Let's start. Buying a stock because the price is low. This is one of the things that we have all done, and I have done it myself in the past. As you get more knowledgeable, you tend to avoid this kind of situation. And the thing is, buying a stock because it's low in terms of a price, or because it has fallen down like 90% even in some situations, can still be a bad stock to buy. And you have to remember that a currently low price doesn't mean that eventually the stock will move higher. It doesn't mean that at all. Just because it's down 90% or it's like $2, it doesn't mean at all that it's gonna go higher. Because remember, at some point the company can also do a reverse split, for example. And so instead of splitting the stock to more stocks, they can actually reverse split the stock. And so now if you owned 20 shares of $2, you own like 2, for example, for $20 instead. And so you are a reverse split right now, and the stock can fall from $20 if the financials do not improve. And so you need to be buying a stock that has solid fundamentals regardless of the stock price. It is very, very important to do that. And if the stock price is already down and you are buying a good company, that's a good thing. This is a benefit because it means that you are buying something for cheap. You are buying value for cheap, and you want to be doing that, of course. Now, buying cyclical companies at their peak. I love trading cyclical companies, and you notice that I mentioned trading there. Cyclical companies are not companies that I like to hold in my portfolio for a long time. I want to buy them at their low, when they are bottoming, before we are entering a new cycle, and basically sell them when the cycle is about to end, or at least it's near its peak pretty much. Now, cyclical companies, in case you are not aware of what they are, these are basically companies that go up and down seasonally in terms of market conditions. So they're affected by market conditions. For example, oil companies. Remember 2 years ago, they were bottoming. A lot of these companies went bankrupt. Or casinos, for example, for which I own both right now. I own both oil companies and casinos. And they can be riskier plays, of course, but they're cyclical plays. You want to be buying the ones that have good free cash flow, have a great balance sheet, and little debt. Super important for cyclical companies. Never ever buy cyclical companies that have a lot of debt. It's a very, very risky situation. They can go bankrupt, especially companies that require large amounts of capital, like oil companies, for example, oil miners. Now, it is important to time your purchase so that you do not buy too early. That's important, because if you buy too early, you may be still in the previous situation where the prices are bottoming, and you may be buying a company that is actually having a lot of debt, and they may go bankrupt. You want to be buying when the situation kind of switches, and so you don't want to be buying them at their we don't want to be buying them as they are going down in the early stages, because they can keep going down for a while. You kind of want to buy them when the situation is about to change. So when you are noticing that now all of a sudden oil starts to become a little bit more expensive, this is when you want to be adding those. Okay, so buy too much stock of one company. Very, very important to avoid. A lot of people do that, and it makes sense because they could be finding a company and they like that. They get in love with the company, and then they're like, okay, they are doing great, I need to be buying more. And also they tend to buy even more as the company stock goes down. And as Warren Buffett has said one time, you do not have to make your money back the way you lost it. And generally speaking, it is a bad idea unless you are actually buying value. But if you are buying a stock that is actually, let's say, a net income negative, and they're losing money every year, and then you're down 70%, and you keep buying because at some point you're expecting it to go up, it's a very, very risky idea, a very risky proposition to do so, and it's a very, very bad thing potentially going to happen to you with this stock. So you want to avoid buying just a single stock for the vast majority of your portfolio. You really want to avoid that. Many company valuations are looking like gold right now. Like, for example, Alibaba and Facebook, to my eyes, are amazing in this current time. And even though they are my largest position, I'm still not going more than 5% of my portfolio. This is about discipline, really. You have to be buying other stocks, or you have to be allocating your funds in other stocks as well. You don't want to have everything in just a couple of shares, of stocks, pretty much, because any single company can have some risk, and things can go wrong when you least expect it. You want to be diversified. Don't risk everything in a single. Don't leave your eggs in one basket, as the known saying says. So it is a good idea to balance against industries as well. Of course, you could go and get some consumer cyclicals, consumer discretionary or non-discretionary. You can buy banks, you can buy EVs, you can buy all sorts of companies and be diversified. But what you do not want to do is just hunt industry-specific companies for the sake of it, just to diversify, unless they are solid companies. You don't want to be buying companies just in order to have this industry in your portfolio. You want it to be good companies, cheap companies that have a lot of value as well. Otherwise, it doesn't make sense, and you need to avoid this kind of situation. Now, being impatient, a thing for which I'm guilty of in multiple situations, really. So the toughest opponent in investing is yourself, and you will learn that with experience if you are a new investor. When a stock goes down, people are getting very antsy, very anxious, and they think they should sell because it may go down more, for example. And when a stock goes up, people get like euphoric, and they are jumping into pocket gains, or actually even buy more potentially because it's going up in price. This is about psychology. This is about people's psychology, and it's difficult, very, very difficult to just avoid thinking about this one. And a lot of people, including myself, have done that many, many times in the past. I'm learning to be much, much more patient with the years. As I'm invested more and more in the stock market for many years, I kind of understand how the whole game works, much better at least than what I did back then. And so I know that money is made when you are waiting, really, and you shouldn't be too impatient on daily action, really, unless you are a trader, in which case, okay, that makes sense for you. But if you are an investor and a long-term investor, really, you don't really care about the price fluctuations that can happen in a day, and you shouldn't be impatient about cashing in on your stocks as well. Give them time to grow. It takes time for your investment to do well, pretty much. And so investing is a goal-oriented game. It's also almost like a set it and forget it venture, really. And so as you can see here, I very rarely check my profit loss during a day, because it is irrelevant, and it makes me antsy for no reason, makes me nervous or euphoric, for example, if the stock price is up, if the stock market is up. So I kind of tend to avoid that, because the more euphoric you get, or the more nervous you get, the more likely you are to make wrong decisions. So you kind of want to avoid that and be as objective as possible. Just forget about what is happening during the day. Now, I do check things because I'm making the videos, I'm making news videos, I'm talking about investing, and I enjoy talking about investing. But I want to be actually separating myself from my investments and pretty much forget about those. And frankly, I'm not even joking about this. There are companies in my portfolio that I don't even remember having bought right now, because I have a lot of those. And I actually have to check how much I bought, because I bought them like many years ago. I don't even know what some of these are doing. I may have checked like here and there, but I just let them grow with the years, let them accumulate. Sometimes I also have some dividends, although I'm not a big fan. But you need to be separating yourself again from your investments. And remember that stocks are one of the things that people like buying when it's higher in price, and you need to detach yourself from that. Now, as I mentioned in our Discord, for example, people love buying cheap sugar, but they love buying expensive stocks too. And so that doesn't make sense. You should love buying cheap stocks. So be patient, set and forget, and don't be too anxious about what is going to be happening with your investments in the day. Pay a fee for financial experts here. I have talked with many like colleagues of the past or friends who were paying these pretty much platforms and financial experts pretty much to give them ideas on what kind of companies to invest in and basically manage their portfolio for a little fee. Now, luckily I haven't done this mistake, I haven't made this mistake, but I have heard of a lot of people making this one, and I have to tell you that paying for a fee for financial management is a massive ripoff. You really need to avoid that and kinda learn the basics yourself, take your decisions yourself, and do not really pay this kind of money, this kind of fees for a financial management service. It makes zero sense, trust me, they don't know better than you unless you have no idea. But if you are willing to learn a few things and just understand how the market works, this is what we are doing in this channel. Hopefully we are trying to help you in your journey. You really don't need that, trust me. And it will cost you millions in the long run. You cannot really get it right now, but losing 1% of your portfolio in a year as a fee to your online financial expert is tremendous. If you do the math, you will see that you will be losing about like $1 million in like 30 years time in compounded gains, again depending on your capital, for example, but of course if you have a respectable capital. And so this is very, very bad for you to be spending this money for no reason really. And the highest that you should pay is basically for an index fund, which is super low. Typically it's like 0.04 or 0.15%, maybe the highest one that I have seen for funds like Vanguard funds, for example, which you should be looking for if you're buying funds. And basically try to avoid the mutual funds that are managed. Not a good idea. You are paying fees that are ripoff for no reason, and you're more than likely not going to beat an index fund as well, like the S&P 500. Buy a stock at its high because it is trending. Many people have done that as well and still are doing it. And as I'm mentioning here, a stock is not a ticket to Coachella or the NBA. The best purchases happen when the stock is silent. You don't want the trendy stuff. The trendy stuff is there for price hikes. You want to be buying stuff when they are not trendy, and maybe at some point you are gonna be gaining the extra, stock price because of the trend, because your silent stock in the day now becomes a trendy one. It becomes a positive sentiment company, and it keeps skyrocketing. This is what you need to be doing. So when volume is low and people are kind of indifferent about a company, you are checking the financials and you are seeing value, a lot of value for a cheap price, and it is then when you buy. You don't really want to be buying the expensive companies that are trading like Tesla at a P/E ratio of like 2000 at some point or something of that sort. You really want to avoid that. It's a massive mistake, and you may get lucky and the sentiment never dissipates, but if it does dissipate or if we enter a recession, you are likely to be completely annihilated in terms of that stock or company. And never watch a video and just go buy a stock because someone is telling you to, regardless of what they're telling you in terms of the financials. Never. Always do your research. Avoid pitfalls, especially like pump and dump schemes that are telling you to buy as the stock is going higher or as there is a little bit of a pullback. You don't want to do that. You want to be examining financials on your own and just see what is happening with the company, what kind of money they are making. Use the discounted cash flow model, discover what the company is making objectively, and do not just follow the trends. Do not just follow what people are buying just because the price of the stock is high. Doesn't make sense. Again, this is not a fame contest really. So, trying to find reasons to buy. This is another bad thing to do. A lot of people are actually want to buy a company, like really want to buy a company, and so they are trying to find reasons to buy the company. And this is a very bad idea. Investing is about not finding reasons not to buy, not finding reasons to buy. You want to be examining a company from the standpoint of a critic. Be like, okay, this is bad, this is bad, this is bad. Okay, we're having 5 bad things, which could potentially mitigate it because of this thing or that thing. So you are trying to make a negative case, and then you are trying to see whether this kind of negative case is not negative enough for you to avoid the stock. This is what you should be doing. when an article is telling you that, let's just say, the price to sales ratio of a company is very low, then stop a little bit and rethink. Why are they telling you about the price to sales ratio when they could be telling you about the P ratio or the price to free cash flow or the discounted cash flow model? They're more than likely telling you about the price to sales ratio because it's the only positive thing or one of the few positive things. But why is it positive? Because the price to sales ratio could be because the company is increasing revenues but they're not making money. They could be making tons of sales but offering massive amounts in discounts. And so I can do millions in revenue if I'm not making any money, because I can basically give you all sorts of discounts in order for you to buy my stuff. Is the company selling a ton but they are still losing money on every sale? Maybe they're having operating issues. And a company that is not making money, what is that company worth to you if they never make money? I'd say nothing. I mean, they have to prove themselves by actually making money, because businesses are about free cash flow. If you do not make free cash flow, you are not a business. You are a venture that is trying to make free cash flow, is what you are. And so, yeah, discover reasons not to buy. And if not too many of them are around, or if they are mostly based on market conditions or sentiment, then that's more than likely a very good sign, because market sentiment and conditions typically tend to last for a little while. They tend to be a cycle. And so if the company's financials are great, you should more than likely be looking to add this one to your portfolio. Invest in too many dividend stocks. Now, I understand that there are a lot of like YouTube channels and investors loving dividends. I totally get that. And frankly, okay, I understand it. I mean, there are some definitely positive arguments to make about dividend stocks. But I have found myself that even though it used to be my thing some years ago, I'm not a big fan anymore. They can be a good hedge against inflation because they are providing you with some income, pretty much, a passive income even. And low growth market conditions could actually be a nice case for buying dividend stocks. So right now, it may be a good idea to add some dividend stocks to your portfolio, and I would recommend it overall. But generally speaking, they are very, very inefficient, because dividends are taxed twice. Remember that the company is taxed once when they're making their net income. Now, EBITDA is income. Remember, it's earnings before income, depreciation, amortization, and also taxes, of course. And so net income is actually the profit that comes after taxes as well. So with all of these expenses deducted. And also, when the dividends are allocated, the investor is taxed again on their gains, or because they are making money on their dividends. So there's basically double taxation here, and this is basically money down the drain for the company and the investors, because remember, the company is about the investors. That's you. And so dividend payments retract retained earnings from the company. What are retained earnings? We have talked about this. Retained earnings is basically an account that shows you the cumulative effect of net income that the company generates through the years. It's almost like a sum of the profit and loss through the years. That's what it is, pretty much. And so as the company is extracting dividends, this worsens the retained earnings. And so this worsens the company's financial position and balance sheet because of that. This is a balance sheet item. And so it makes it especially difficult to grow operations and stock price, because the company is reducing their free cash flow. It's reducing the money that they can put to work to actually generate even more money. So this is some of the reasons why I don't really like investing in too many dividend stocks. So not having extra cash. I understand, and you should understand, of course, too, that money in terms of cash, especially in an inflationary environment, is not a great idea to just hold. But you always need to be having some extra cash for a multitude of reasons, really. The first thing, which I have talked about in many of my videos, very, very crucial, you need to be making sure that all your needs, your family needs, your personal needs are and will be met comfortably for the next few years easily after you deduce the money that you deduct your money that you pay for your investments. And you should consider putting money towards investing as money that you don't have anymore. So basically money that you basically just burned. Consider them gone. Consider this money gone. And under no circumstances should you be in a situation where you need to be pulling this kind of investments money as cash for your personal needs, really. You shouldn't be pulling this cash out of stocks you should basically be considering them dead money, treating them as that, because if you have to do that, then you may be selling without proper analysis, and you may be selling just because you need the money. It's a very, very bad idea. And even when the market is low, you always need to be having some cash at hand, because opportunities arise all the time. And it's a very, very bad idea to have to sell other investments in order to buy a new one that's looking like a better opportunity, unless you sold your previous investments because they were not a good opportunity anymore, of course. And last but not least, buying leveraged instruments. This is a mistake that can cost you a massive amount of money. Thankfully, I haven't been hurt from this one, but I have seen and heard about a lot of people doing that because they don't understand how these instruments work. These are like leveraged instruments, and by instruments I mean stocks, ETFs, basically whatever you can invest in. And typically you will find them as an ETF, and the point behind leveraged instruments is that they are trying to magnify the gains and losses of an asset through derivatives. And so for nuggets, for instance, we're talking about an ETF that is backing gold miners, and it's a 3 times leveraged ETF, which means that if the company makes 5%, if the miners basically make 5% on average that day, then Nugget, this ETF here, will make 15% for a gain that day. Now, on theory, this sounds amazing, like you could be making a lot of money, right? I mean, if it goes down like 10%, then you gain 30%. But it is actually a grave mistake to invest in these kinds of instruments, and the vast majority of these instruments will lose tons of money, probably 90% or more of their value eventually, and they are not even meant to be investments. They are meant for traders only, pretty much. But a lot of people do not know what they are and what a big mistake can be to buy those. So this is why I wanted to make a point about this one. So why is this a problem? It is because of something called the decay effect. And picture this idea: you bought a share of $10 here. That's a Nugget ETF share. And so day one, gold miners are down 10%. This can happen very easily, especially with gold. Nugget is 3 times that, so now it's down 30%, minus 30%. Your $10 ETF now costs $7, so you have lost 30%, right? Now day two, now you are up 10%, and you will be thinking, okay, now I made my money back, right? But not so fast. Nugget is, remember, 3 times, so that's 30%. And so your $7 ETF now becomes 9.1, not 10. Because remember, going from $10 to $5 is a 50% loss. But going from $5 to $10 is a 100% gain. This is crucial for this kind of instruments here, because they can go down in a blink. They can lose 50% in a day. And so in order for you to get back to what you were before that loss, you have to recoup massive amounts of losses and basically double your investment at that time. You just lost half of it, now you need to basically double it in order to make it again. Lost 50%, you need to be making 100% just to break even. So this can be a big, big mistake. So try to avoid this unless you are trading them for like a day. And yeah, you're just holding as a trader. Alright, so that's what I wanted to talk about in this video. Hopefully that was a little bit useful to you. Let me know, and let me know what you think is the best or maybe even the worst of the bullet points here that I made. And let me know what is your mistake that you think that it's like the most grave mistake that you can make in the stock market. Tell me what your opinion is about this one. And remember to leave a like and subscribe if you like this kind of content, of course. And do let me know if you are interested in these kinds of videos and what other kind of topics you'd like to talk about. And maybe I can create some presentations for those, and we can talk about those in more detail. Thanks for watching again, and I'll see you in the next video. Have an awesome weekend, guys. Bye bye.